Hey everybody, John King with Summit Funding. Thankfully, nobody was watching live a moment ago, but for those of you who are watching this recorded, you'll see my little goof up at the beginning. I apologize for that. I need to share my screen, and I started to click the share button to get the share ready and didn't realize it was going to actually take away from the video that we were playing as my intro. Anyway, I know you all wait every single week to listen to my intro, and so that just ruined it, that it got delayed by a couple of seconds. Anyway, appreciate everybody listening in today. Super excited about this topic. So first of all, as a preface, every single Friday I come to you with a new topic about your finances, whether it be about your personal finances. We've done topics about car loans or how to estate planning and trusts to financial planning. But a lot of what we do is mortgage related. Why? Well, because I'm a mortgage guy. Shocker, that's what I do. And it's what I'm an expert in. So today is no different. We're going to be doing a review of the USDA loan program. So this is what I'm going to call my USDA Loans 101. So this program is going to be, this episode, if I can call it that, is going to be really in depth on what is a USDA loan, how does it work, who should use it, when, and why, and hopefully give you a good feel for it. My audience, as I'm talking to, is typically first-time home buyers and other buyers who are looking to buy homes and real estate agents. So I'll be kind of talking to both as we talk through here and really give you a good understanding of how we can serve you, but also how we can serve your clients if you're a realtor or if you know somebody else who needs to have this type of financing. I'll be able to give you all the information you need. So let's go ahead and dive in. First of all, why USDA? That is the United States Department of Agriculture. Yes, that is the department that handles meat and livestock and farming. And why in the world is the U.S. Department of Agriculture providing a loan in the mortgage space? Like, it makes no sense. Well, here's the deal. The Department of Agriculture obviously is in charge of making sure that America is fed, that we have all the food, all the grain, all the meat that we need. And the truth is, it takes a large workforce, a very large workforce, to sustain the breadbasket of America. And the problem is, finding good financing in rural areas for a long time was really hard to do. The banks, community banks, would only loan where they were at, and there was nobody lending money in mass. And we had challenges with just keeping good people working in the farmlands of America. And so USDA stepped in and they said, hey, we'll jump in here and we will provide a loan program that will give zero down payments to people who live in rural communities. You don't have to work in the department or in the agricultural industry, but people who live in rural areas, you get to have some benefits over what you would get if you didn't live in a rural area using this U.S. Department of Agriculture program. So what's the benefit of doing USDA? Why in the world would anybody choose to take out a USDA loan? Well, let me first go a little bit higher level and say there's four main types of loans that are government backed or run through the government. And those are conventional loans made up of Fannie Mae or Freddie Mac. So conventional. I was going to say four. So conventional is one. FHA loan, which is backed by the Federal Housing Administration and HUD, Department of Housing and Development, Housing and Urban Development. The third type of loan is VA. So the Veterans Administration, similar type of situation where VA stepped in and said, we need to do loans to take care of those that served our community. And so VA loans are a very critical part of the lending process, or the four types of loans. The fourth being USDA. So USDA replaces the need for VA or FHA or a conventional loan. Now, technically outside of those four is what we call non-conforming. That's actually the topic we're going to be talking about next week. So on my live stream next week, I'm going to be talking about specifically how to help self-employed people get home loans through this non-conforming category. But non-conforming also talks about jumbo loans, like over the conventional limits. It might be loans for people that have lower credit scores that don't meet any of the criteria of the first 4 programs. But most of the non-conforming loans have higher interest rates and or higher fees. So the main 4, conventional, FHA, VA, and USDA. So we're talking about USDA replacing the need to do conventional FHA or VA. Why? Why would I want to do that? First of all, it's got a lot of characteristics similar to VA and similar to FHA, but better in some ways. So the first thing I'll tell you is my hierarchy. If you said, John, I am a veteran buying in a rural area, and so I can do a VA loan, I can do a USDA loan, I can do an FHA loan, or I can do a conventional loan. My first question is, how big is your down payment? And if you said, John, I don't have much money for a down payment, matter of fact, I'd like to put nothing down if possible, then the hierarchy is VA is almost always the best. So VA is number 1. Number 2 is going to be USDA. USDA has some big benefits that make it better for small down payments than FHA or conventional. The problem is the rule book for VA for USDA is tighter. So I'll talk about that as we go forward through this conversation, but VA is top. If you qualify and can use VA and you're putting a small down payment, I'm almost always going to tell you to go VA. If you're not a veteran, then if you're in a rural area, I'd say you're likely to go USDA as long as you meet the rules of USDA. Otherwise, it's going to depend on your credit score as to whether you're better off going conventional or FHA. So that's my hierarchy of how I think about the loan programs. What does USDA offer? First of all, 0 down payments. Now you have closing costs, but you have 0 down payment. So therefore, you can buy a home using USDA, and instead of putting 3.5% down like FHA or 3 to 5% down for conventional, you can do 0 down payment. And you don't have to be a first-time home buyer. So VA doesn't require a first-time home buyer either, but you have to be a veteran. So if you're not a veteran, USDA don't have to be a first-time home buyer. You can put 0 down. Remember, FHA does not require you to be a first-time home buyer either, but conventional does. If you want to do 3% down on conventional, you have to be a first-time home buyer in most cases, or you have to put 5% down. So USDA has a lower down payment requirement. USDA has less expensive mortgage insurance. So it's called their guarantee fee. I'll talk about it in a little bit, but USDA's guarantee fee is cheaper than what the guarantee fee is for FHA, or what the mortgage insurance is for FHA. Guarantee fee, mortgage insurance, it's the same concept. You're paying money to pay for the risk of the loan. All right, so what are the negatives of USDA? So first of all, USDA loan programs have income limits that VA, FHA, and conventional don't. So you cannot make over a certain dollar amount in income, or you can't qualify for a USDA loan. USDA loans have geographic restrictions. So you have to live within a certain area, and it's really outside of majorly populated areas. And we'll take a look at the map in a couple of minutes. And USDA is tighter on their debt to income ratio requirements. You got to be careful that maybe you qualified for FHA, but your debt to income ratio is too high to qualify for USDA. And I'll explain a little bit more about that going forward. All right, so let's take a look at the geographic restrictions. And I'm now going to share my screen so that I do not mess that up like I did a couple of minutes ago. And I want to share the entire window right here. And so now I am sharing. So you guys should be able to see this window. And let's see if that is better. All right, perfect. And so this is the USDA website. You will actually be able to go to usda.johnloanking.com, and you can get a link to this website. We're in the middle of building it out, so right now it's a placeholder. But if you go there on Monday, you should be able to get to this website. We'll have a copy of this video on here and lots of these links. So this is the website that you're going to in order to look up USDA income limits and geographic restrictions. And so we're going to start with the geographic restrictions. The first thing I'm going to tell you really quick is there's 2 programs. There's guaranteed and direct. So the direct program is for very low income applicants, and it's really, 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 really hard to qualify. I've never done a direct loan. The guaranteed loan is for moderate income households, and it is typically it is the USDA program that we use. So when you go in here, go to the single family guaranteed program, okay? And now you've got property eligibility and you've got income limits. So we're going to start with property eligibility. And what it does is it takes you to a map, okay? So you should be able to see this map pretty good. And I'm going to just simply, you can type in an address. So you can find your address and it can tell you if you are in a USDA eligible area. So I'm actually going to put in the address of my Lodi office, 801 South Ham Lane, Lodi, California. And let's see what it says. It's going to search. It should be searching. Maybe not. All right, well, let's pretend it searched. What I'll tell you, though, is it'll zoom in to the map, and it will actually show you that address. I don't know why it's not zooming in. Anyway, oh, here we go. Nope. Oh, it's not finding it. 95242. There we go. It needed a zip code. So once I put the address in there, it tells me exactly this address is not in an eligible area to put a pinpoint. Why does that matter? Because it matters what side of the street you're on. Here's an example. This is Tecklenburg Road, North Tecklenburg Road in Lodi. Well, guess what? If you live on the corner of East Realty and North Tecklenburg Road, you may or may not be USDA eligible, whether you are on the east side of that road or the west side of that road. So just because you live on Tecklenburg does not mean you are USDA eligible or ineligible. And then it gets even goofier because at certain points, the map ends up turning at a street corner. So like right here, you can be turning right here. So therefore, the people who live here, they can do USDA. Somebody who lives here cannot do USDA. Hopefully you can see my cursor on here, so you got a decent idea of what I'm showing. But anyway, you can see the basic breakdown of that. Now let's zoom back out and let's get a feel for what is eligible in California. So as I zoom out, I'm going to start with Northern California. What do you notice? What you notice is that it's the populated areas that are in what's that, tan color, brown color. So on the bottom right corner, it says that these are ineligible areas. And so what we've got here is anything around Sacramento, upwards to Yuba City, Carson City up here heading into Lake Tahoe. As we head down towards San Francisco, you see the entire San Francisco Bay Area is pretty much not eligible for USDA financing. But there's some spots that are. They're not very highly populated, but as you look, like you can head out right here and heading out 680, there's some spots right here where if you live on the Sunol grade area in Highway 680, then you actually could qualify for USDA financing, just not sure what kind of homes are out there. Same thing as you head into Half Moon Bay. So if you were buying a property on the coast of the peninsula in the Half Moon Bay area just south of San Francisco, that is all USDA eligible. So there's options, but it's going to depend on where you're at. If we zoom down to Southern California, hold on 1 minute here. So I zoom down the state. You'll notice as we head down the state, we got pockets on 99, Los Banos, Fresno, Madera, Visalia, Hanford. All of these are not eligible. Bakersfield, but then on the coast, San Luis Obispo, Santa Maria, Santa Barbara, and then we hit the greater Los Angeles basin. And so you see that around this area, these are highly populated areas that are not eligible for USDA. So if you ended up in the Santa Clarita area, you can move forward with USDA, but only if you're really out here heading towards the valley. You got a small area in the pass here, and then you can't do it once you hit Palmdale. So you're really limited to the geography in certain areas, the entire LA basin with a few minor exceptions. And again, I'm not sure what's really out here. Here's where there's some spots in California, I'm going to use in my backyard up here in Northern California, that you find are actually highly populated areas that allow for USDA. And Galt is a perfect example. So here's what happened with USDA. And I'm going to zoom out here really quick and do this. Here's what happened with USDA. Every 10 years, USDA had updated their map, and they had said, hey, we are going to allow for certain population limits. And if you're at the census, every 10 years of the census, they're going to review the population, and they're going to determine if an area is added to or removed from USDA eligibility. Galt, as an example, in 2000 was a tiny small town, very, very low population, and it met the USDA guidelines. Now we fast forward to the 2010 census. Now, mind you, what happened between the 2000 census and the 2010 census is that we had a huge run up in house prices. We had a bubble that burst, and we had a crashing of house prices, and we had a recession that was happening in 2010. So that census happens, and around 2012, they're going to update the maps to say, oh yeah, these areas don't qualify anymore. Areas like Galt don't qualify for USDA because, well, gosh, between 2000 and 2007, it exploded. It was a perfectly situated spot between Sacramento and Stockton, and it exploded. So I'll show you again here really quick. So as you're looking at Galt, and you should be able to see it right there. Yeah. So as you're looking at Galt, you can see that it's perfectly well situated between Sacramento. So you got Sacramento to the north, you've got Lodi and Stockton to the south, and Galt is right here in the middle. And so there was a big uproar. And the uproar was that the people who lived in Galt and even the legislators said, well, that's not right, because we need to help to preserve home ownership and grow home ownership during this recession. And so they basically said, you know what? We're going to pass a law that we're going to ignore the future changes. If an area has grown too much to no longer be eligible for USDA, we're going to ignore that. Now that happened in 2010. Guess what? 3 years ago, we had another census in 2020. They did the same thing. They ignored the implementation of the higher density areas. And so you've got pockets that are actually very highly populated, like Galt, California, that still qualify for USDA because they were tiny back in 2000 when the last census was applied to the mapping. So it's critical that you understand where you can buy and where you cannot buy. So if we're looking at this map, we're basically saying, hey, all across the state of California, you've got a lot of spaces that you can buy a home, but you have a lot of spaces that you can't in the highly populated areas. So San Francisco Bay Area, Los Angeles, San Diego, you cannot use USDA. But if you're in the north part of the state, you can't use it in Redding or Eureka. But aside from that, the entire north state is pretty well available. Chico's not available, Oroville and Yuba City, but you got a lot of land in the north state that you can use. So if you live in the north state, USDA is a really, really good loan program to help you to qualify for a home with zero down payment. All right. So let's talk about income limits. So we'll look at them in just a second. The first thing I want to talk about is who counts in the income limit. This is one of the negatives of USDA is everybody living in the household counts, even if their income is not being used to qualify. Certain programs, certain down payment assistance programs have similar rules where they say, hey, no matter what your credit score is, no matter what, if you have income, then we're counting that income if you're living in the house. Now, here's the catch-22. The more people you have living in the house, the higher your income limit. Now, some programs have the same income limit regardless of your family size. Some programs have income limits based on, hey, for one person it's this, and two people it's that, and three people it's that. USDA is unique in that it's got two tiers. It's got 1 through 4 family members and 5 through 8, or really 5 and above, because over 8 is still the same. So you got two different tiers that the system is looking at for income limits, but it's the income of everybody in the house. So if grandma lives with you and gets Social Security, but she's not going to be on the loan, then you have to count her income in the threshold, because USDA is going to ask you to do an affidavit to confirm how many people are living in the house and do they have income. Now, children, they're going to understand don't have income. Adults, they're going to want to get a transcript of their taxes to confirm that there's no income coming in for that person. So be very, very aware that the income limit is for everybody who is living in the household. All right, so let's go ahead now and let's take a look at the income limit. So I'm going to go right here to income limits. Yeah, that's fine. I'm fine with a PDF. That's what I want. All right, so here's the USDA income limits. And we are simply going to click on the state of California. And what you're going to see is you're going to see a list of MSAs. Basically, it's a metropolitan statistical area. The key is we're going to use this third line in every MSA. So we're going to use, if you're in Bakersfield, we're going to use this income limit, which is for a family of 1 to 4 people of $104,650. If you are 5 through 8 plus, which is really 5 and above, you have an income limit of $138,150. So as long as everybody in the household's income does not exceed that number, then you are eligible. Doesn't mean you pass the debt to income ratio requirement. So you have to have enough income to pay all your bills, but not too much income to exceed this limit. And so you're basically looking, and I'm an expert on this, so I'll help you walk through it. But for example, again, Los Angeles County, hey, you can make $138,000. The problem is there's no properties in Los Angeles County that qualify you. If you were buying in San Francisco County, which is San Francisco City, but San Francisco, Oakland, Berkeley, et cetera, you can make $159,000 for a family of 1 to 4, $210,000 for a family of 5 to 8. The problem is you don't have any properties in that area. Now, you do in San Mateo County. Okay, so San Mateo County, am I finding it here? Hold on, let me search it. San Mateo. Oh, so we then have to dig a little bit further to find out which MSA. I'm guessing it's going to be in the San Francisco, Oakland, Berkeley MSA. And although it could be in the San Jose MSA. So we'd have to look that up to figure out which markets that they are requiring us to tie into. But you've got the Half Moon Bay Coast, that you can buy a property on the Half Moon Bay Coast. Now, again, depending upon what you're buying, that might be a pretty expensive property, and you're not going to be able to qualify for that. But even if you made, by the way, in San Francisco, a family of 1 to 4 can make up to $238,000, $314,000 for a family of 5 or more. But I don't think there's any properties in San Francisco County that qualify. And this limit is based upon what county you are buying in. So some programs like the WISH program I talked about a few weeks ago, it's based on what county you live in when you qualify. This is where I am an expert on this stuff, and you got to be careful about who you're trusting to guide you through the process, because every program has nuances and differences. So the USDA program says it's the income limits of where you're buying. So if somebody in San Francisco moved to Sacramento to buy a home, they can't use the San Francisco income limit for USDA, but they can use the San Francisco income limit for the WISH program, which can give you up to $29,000 of assistance towards your down payment and closing costs. So if you don't know anything about that, check that out in my library, because I did a video a few weeks ago about it, and it's a really, really good program that does a match of $4 to every $1 you put in, up to $29,000 of matched money. So it's a great option to help you, but I won't get off on tangent there, as much as I will say the income limits are based on where the property is located for USDA. All right, so let's talk about debt to income ratios. USDA has some of the most strict debt to income ratios of the 4 main programs. So debt to income is how much monthly payments you have going out compared to how much monthly income you have coming in, gross monthly income. Now that, again, I'm an expert on running that calculation, but what I'll tell you is FHA is very, very forgiving. VA is very forgiving. Even conventional loans. An FHA loan will let me go up to 55% of your income towards your bills. VA will let me go sometimes even higher. I've gotten loans approved VA 55, 60, 65%, because VA cares about something different called residual income. I'm not going to get into that today. Conventional loans let us go up to 50% of your income towards your bills. USDA wants us to stop at 43% in most cases. And they won't let us spend more than around 31 to 35% of your income towards your house payment. So USDA is very strict. It is really one of the key reasons why people don't qualify. So the first reason they wouldn't qualify is you make too much money. But those income limits are pretty reasonable, pretty generous. So the second reason why people wouldn't qualify is because of the income to debt ratio requirements. If somebody says, John, I'm qualified for FHA, but I'm buying out here in wherever, and it qualifies for USDA, I'm a first-time home buyer, I don't exceed the income limit, so I should be able to go USDA. The problem is that FHA lets us go a lot higher in debt to income ratio than USDA is going to let us. So you wouldn't qualify for the same amount of purchase price. It is still a great, great program, but it's just different in how it looks at the numbers and qualification, and it's much, much harder to qualify. Which brings me to GUS. Okay, so GUS is the guaranteed underwriting system that USDA requires I run the loans through. There's actually computer systems for all of the programs. Fannie Mae and Freddie Mac have computer systems called Fannie Mae is desktop underwriting and Freddie Mac is loan prospector, and USDA uses GUS. FHA uses their total scorecard system. So everything has a computer system, but GUS is pretty particular. GUS is pretty mean sometimes. So USDA is probably one of the more strict programs out of the top four. In some ways, it can be way more strict than even a conventional loan. So you got to be careful about us saying, or even I won't say, hey, you know what, it looks good. I want to run it through GUS first, because GUS has surprised me many times. And when I thought somebody would qualify USDA, GUS doesn't like it. So it's an important thing to understand. All right. Do these loans take longer than normal loans? Maybe. So here's the deal. USDA loans have one more layer of approval, and that is through the federal government. We actually have to send the loan to USDA for final approval. So once we've approved it, we have to send it to them for final approval, kind of like Cal HFA requires us to do. The problem is that USDA is hit and miss sometimes on how quickly they're processing those loans. The second thing is USDA can technically run out of money. In other words, their year starts in October, and sometimes they don't have the funding allocation set up yet. And so it can technically be around September, October that we cannot lock a USDA loan. Also, if there's an issue with the debt ceiling, which is kind of coming up in the next couple of weeks, and there's a shutdown of the government where people can't go to work because the government can't afford to pay them because they don't have the money to pay them, then all USDA loans would screech to a halt because we can't final approve it until it goes to the USDA underwriter, who is an employee of the federal government. And if the debt ceiling issue is not resolved and they decide that they're going to shut down the government in order to, because they can't pay their bills, which has happened before, the government's been shut down before for short periods of time, that would be an issue with USDA as well. All right, so let's talk about some specifics. First of all, can you use down payment assistance with USDA? John, why would I want down payment assistance with USDA, you ask? Well, that's a great question. Let me tell you, because you have closing costs. So USDA has closing costs just like any other loan program. So even though we loan you 100% of the purchase price, we're not loaning you any money for the closing costs other than USDA's guarantee fee. So therefore, you have to come up with some money that can be anywhere from 3 to 5% of the purchase price. And that's on the high end. It's not any more expensive than any normal loan, but it's most of these loans are smaller loan amounts, and smaller loan amounts, the percentage is higher in closing costs. Why? Because the loan amount does not determine how much the appraisal fee is. The loan amount doesn't determine how much the underwriting fee is. It costs the same amount of money to underwrite a loan that is on a $250,000 property as it does to underwrite a loan on a $500,000 property. So that underwriting fee, that appraisal fee, is twice the percentage of the $250,000 loan as it is the $500,000 loan. So don't get too stuck on percentages. I like to say closing costs are $10,000 to $15,000 on average, with 3% to 4% being another kind of validation of that number. All right, so what can you do with down payment assistance? Well, the CalHFA program actually does the USDA loan with a 3% My Home loan. So you'd get USDA and you get a second mortgage, and you would have 3% to pay a majority of the closing costs. Now with the My Home program, which I talked about a couple of weeks ago on another video, you don't make any monthly payments. You pay 1% interest each year that's added to your balance, and you pay it off when you sell or refinance the home. You can also layer USDA with the WISH program. You can actually use the USDA with the House HAF Fund, the Housing Affordability Fund through the California Association of Realtors. So that is something I mentioned actually on my weekly market update video today that is going to be released. If it hasn't been published yet, it will be published in the next few hours on my John Lone King YouTube channel. And I talk about the HAF Fund, and it basically is $10,000 of assistance that you can get as long as you live in the house for 3 years. There's lots of restrictions on that program. Check out the video that I published today. As a matter of fact, I just got notification that it has in fact been published. So if you go to my John Lone King YouTube channel, just go to YouTube and search John Lone King, which is right up on the top right there above me. Subscribe at John Lone King on YouTube, and you'll be able to, and it's also right down there. You see it going right there, right there. There it is. So anyway, check that out. That talks about the HAF program in the video that has already been published. All right, so now let's talk about the property. The property must meet FHA guidelines. So it is kind of a quasi hybrid between conventional and FHA, but it's a conventional loan, but it has to meet FHA's guidelines for property. So it is important to understand that the property has to have no health and safety issues. It can't be an extravagant property. So, USDA, it won't be anyway based on price range. So that really isn't an issue. But on some USDA programs, they've said you can't have a swimming pool. I am 99% sure that rule's gone away, but they're looking at modest homes is really what they're saying. But the good news is their income limit and their debt to income ratio pretty much forces you to be buying a modest home. All right. I think I said this before, but you do not have to be a first-time home buyer with USDA. Now let's talk about mortgage insurance. So first of all, it's not mortgage insurance. It's a guarantee fee. What's the difference? There isn't one. It's just the name. VA calls it a funding fee. FHA calls it MIP, or your mortgage insurance premium, versus conventional loans call it PMI, which is private mortgage insurance, and USDA calls it a guarantee fee. It's money you pay for the privilege of putting less down payment. So USDA has better fees than FHA. USDA charges a 1% upfront fee versus FHA charging 1.75%. So it saves you money out of pocket, not out of pocket. It's actually including your loan amount. So if you bought a $100,000 home, USDA is loaning you $101,000 to pay the guarantee fee. The same with FHA. If you bought a $100,000 home, FHA charges you 1.75%, but they actually loan you $101,750 to pay that fee. So USDA's upfront fee is cheaper than FHA's upfront fee, and USDA's mortgage annual fee, the fee that you pay as part of your monthly payment. So both FHA and USDA make you pay a fee up front, and they make you pay a fee every single month. Well, FHA's came down to 0.55 earlier this year from 0.85%, but USDA is at 0.35%. So by and large, USDA is cheaper when it comes to the mortgage insurance, the monthly fee you pay, and the one-time upfront fee you pay. So I just want to remind you as we wrap this up, if you have any questions, feel free to post those questions into chat and wherever you're watching right now, and I'll answer those questions. I've had a relatively quiet group today, but that's refreshing because last week I had a lot of questions. Not that I don't mind that. I like having lots of questions. Anyway, so this is, you would go to usda.johnloneking.com. That site is being built right now. So right now you're going to get a placeholder. You're not going to see anything, but we're building it out very, very quickly. I expect by early next week. By the time you watch this recorded, you'll be able to get it. And what it will do is give you links to the USDA website. It'll have a link to this video. It will have information about how USDA works and how to qualify for the USDA loans. It's kind of my hub for helping you to qualify for USDA financing. All right, so at this point, I am open for questions. It does not look like I have any yet, so I will simply wrap up by reminding you and inviting you to come next week. I'm going to talk about how a self-employed person can qualify for a mortgage even though their bank turned them down. So really, really important topic to help people who look, when you're self-employed, it's tough. So next steps, get ready. If you want to move forward with your homeownership journey, I am interviewing for that job. So please go to my website, or you can scan that QR code, and make sure to subscribe to both of my YouTube channels. So my main channel is at John Lone King. My secondary channel is at California Dream for All. And just know that I am here to help answer all of your questions and guide you through the process. So if there aren't any further questions, Anna's going to make that screen disappear so you can see me as I say thank you for joining me. Please reach out if you have questions about USDA or any other program, and just know that I'm here to guide you and take great care of you through the home buying process. By the way, USDA does let you refinance without having to get an appraisal. So similar to FHA, there's another benefit. If you have a USDA loan, you can refinance as well. All right, guys, thanks so much. Have a wonderful weekend, and we'll talk to y'all soon. Bye-bye.